Guys, the recent market highs warrant immediate caution, and we're suggesting you reconsider the current market narrative. Everyone is speaking of at least 3 Fed rate cuts coming soon. But what happens if that anticipated move doesn't come to pass? What if, instead, the scales tip in the other direction? Could your portfolio withstand the shockwaves? We think it's a central question that most investors just simply aren't imagining, and that the level of complacency is way too high. Thanks for joining Investor Wise, and we want to make a case to be more cautious now. Let's dive in as to why. The Federal Reserve, or the Fed as it's commonly known, is the central bank of the United States. It's the institution that sets the tone for the country's economic stability, steering the ship through the turbulent waters of inflation, unemployment, and financial crises. And the Fed's decisions echo through the corridors of Wall Street, influencing the performance of stocks, bonds, and other financial assets. And they seem to enjoy the general market's support. As it said, "Don't fight the Fed." But should you trust that? Despite the Fed's attempts to assert control, the debt markets present a contrary narrative, suggesting that interest rates may not fall as expected. US debt levels are at an all-time high, with deficit spending reaching into the trillions. This unprecedented fiscal expansion creates inflationary pressures that exist outside the Fed's scope of control. In fact, while we're told not to fight the Fed, has anyone informed Congress of the same? It's funny, really, as the US government's profligate spending and Fed's goals are actually at odds more now than ever. As an investor, it is crucial to consider these factors as real and unforeseen risks that could upset the financial balance. And don't get lulled into complacency, as we see our portfolios at all-time highs. The current economic environment is rarely accurately portrayed in academic settings, with universities and business schools often glossing over the complexities of government spending practices, and even long-standing dogma like a 2% inflation target being correct or good. The truth is, it could be wrong. However, these practices have a significant impact on the financial landscape and consequently, your investments. Mohammed El-Erian, renowned economist and president of Queen's College, Cambridge, has pointed out the Fed's policy errors. See the link in the description for his most recent CNBC interview. This critique suggests that the Fed's tools, inflation targets, and actions may not be adequate to handle the current economic situation. The takeaway for wise investors is to scrutinize the idea that the Fed's tools and actions are sufficient. It's crucial to not only listen to the Fed's announcements, but to also consider the larger economic picture, including the massive debt levels, deficit spending, and the inflationary forces at play. These factors could significantly affect the trajectory of interest rates and subsequently your investments. Now, imagine a scenario where the Fed, contrary to popular expectation, decides to hold or even increase interest rates. This would send shockwaves through the bond market, particularly the long to intermediate bonds that are expected to benefit from rate cuts. You see, when interest rates go up, bond prices go down. It's a simple inverse relationship. So, if the Fed were to hold or increase rates, bond values could tumble. This isn't necessarily due to a significant rise in rates, but rather because this outcome is so unexpected today. Moreover, all longer duration assets would be at risk if rates stay higher for longer or slightly increase. In fact, you could make the case that the recent rally for stocks to near all-time highs is based on the anticipated Fed cuts. Ironically, the Fed neutral rate may actually be higher than what markets expect and is a hotly debated academic idea, along with the Fed's inflation target of 2%. Again, this is a theoretical target, although almost unanimously accepted as the continued economic gospel. But what if a better or more natural inflation rate is actually 3%? Then what? The Fed, along with the public, is starting to notice a few major problems with inflation, beyond the expected annual rate. The general price level has risen by 25 to 30% in just 3 to 4 years. Even though the rate or pace of increase is falling, which is a positive sign, the reality is that prices for essential goods like rent, housing, and food are stuck at all-time highs. The last 5 years, from 2019 to now, in March of 2024, is likely to go down in history as the worst inflationary period. With real consumer purchasing power eroded, and despite the Fed's supposed dual mandate, namely price stability being a key goal, the reality is the Fed has already failed on this key policy objective, especially when considering housing and rent costs because wages just simply have not kept pace. And corporations, big and small alike, are continuing to cap raises to only 2 to 3%, in line with or even slightly under the real rate of inflation. That is the principal comparison that should be made, but is seemingly overlooked by the Fed, Congress, and other overseers. Can the Fed actually cut rates given this conundrum and risk further destruction in price stability, especially against wage earners? It's a key risk that appears undiscussed, although it's our opinion that wise investors think this through and consider the economic impacts to individuals as a bottoms-up approach to their stock holdings. It's our opinion that the Fed may actually hold steady and that the narrative of higher for longer is not being properly considered. If you made it this far, consider giving us a like and subscribe to support our work of helping wise investors. We really appreciate it. If this is the case, wise investors may want to consider de-risking their portfolios now, holding a bit more cash, and awaiting a pullback with markets near record highs, along with a shorter duration bond bias and even a tilt toward dividend growth stocks versus high PE growth stocks to ensure a cushion against a drawdown. In conclusion, if the anticipated rate cuts don't materialize, the consequences could be profound. Bonds and other long-duration assets could be at risk, and the inflationary pressure, particularly in the housing market, could worsen. Make no mistake about it, the pandemic situation forced the Fed to act, and it's been a difficult challenge over the past 4 years. But the Fed's price stability goal hasn't been accomplished, at least for the average household, family, or single person paying rent, buying groceries and working typical jobs. The ratcheting up of the overall price level of rents, housing, and food, as reflected in real prices elevating upwards of 30% in 4 years, means the Fed's job is definitely not over, and no celebration of a mere 3% annual inflation is warranted. That annual rate is highly deceptive when compared to the gigantic increase already experienced over the past few years, and disingenuous when describing what the average household is up against to pay bills against a backdrop of long-standing stagnant wages. Investors should consider raising cash, adopting a more defensive stance, and recognizing long bonds and high multiple growth stocks as hidden risks. It's always wise to be prepared for all possible scenarios, because in the world of finance, the only certainty is unexpected events, and that having a healthy skepticism of things playing out as expected will help you stay alert and open-minded to what could go wrong and take risk accordingly.